Hello everyone, and welcome back to Dr. Tao's Quant Lab. Today, we have a phenomenal 7 fundamental analysis session lined up, perfectly balancing the extreme momentum of the semiconductor and software sectors with legacy fintech wasouts. What makes this specific section so powerful is the contract inward data. Three of these companies have just renewed their structural gravity with completely fresh earnings data, while we're introducing four brand new, highly requested stocks to our dashboard to see how their algorithmic hype measures up to their math. We will be covering this alphabetically. Arista Networks, ANET, ARM Holdings, ARM, Coinbase, COIN, Datadog, DDOG, Intuit, INTU, NVDA, NVDA, and PayPal, PYPL. Before we dive in, please note the disclaimer on the screen. This is an independent educational project. The views expressed are my own, and this is strictly for educational purposes, not financial advice. If you want to study the underlying mathematics of these models, please refer to section 1.7 of the main Quant Lab course. To understand exactly what the market is pricing in, we map out a stock's gravity using our valuation thermometer. Please feel free to screenshot these slides as we go through them so you can study the coordinates later. Here is how we read the three core segments on our dashboards. Range 1, the blue box, is the deep value floor. This is the absolute worst case scenario pricing based on strict forward estimates. If a stock falls in here, it is experiencing massive market capitulation. Range 2, the red box, is the expected target. This is our core fundamental fair value zone. The middle of this box represents the historical median multiple. If a stock has heavy stock-based compensation, we will also plot an orange box representing Wall Street's adjusted non-GAAP expectations. Stat range, the purple box, is a micro-statistical boundary. This uses a mathematically normal 90-day standard deviation band to show us the immediate short-term algorithmic momentum. Finally, at the bottom of each matrix, we track three vital dates: the last report date, the next report date, and the statistical analysis date. Do not ever trade on obsolete data. Let's look at the charts. We are kicking things off with one of our new dashboard additions, moving straight into the infrastructural side of the AI bomb with Arista Networks, ANET. They provide the critical high-speed data center networking that makes everything else possible. The current price is 137. Let's look at the chart that is operating in perfect harmony with both its momentum and its micro fundamentals. Look at the positioning of the black current price line. It is resting at 137, which places it beautifully inside the purple 90-day micro-statistical band, sitting just below its momentum median of 141. At the exact same time, the price is safely embedded inside the red macro expected target box. Because Arista has robust 23% forward growth estimates, that structural ceiling stretches all the way up to 143, providing total fundamental justification for the current algorithmic evaluation. This is what a completely balanced, highly fundamental chart looks like. The stock is not widely overbought like we see with pure hype plays, nor is it suffering a structural breakdown. For left side accumulation, this represents a fair value entry into a hyper-growth sector. You are paying a premium multiple, but the math fully supports it. But again, we would suggest that wait until it goes back to the median 121 of this red box. For right side momentum traders, the technicals are totally neutral, allowing you to confidently hold and manage your risk against that 126 statistical floor. Next, we bring up another new addition and the ultimate high beta AI momentum parallel, ARM Holdings, ARM. The visual detachment on this chart is absolutely breathtaking. The current price is 209. Let's look at exactly how far algorithmic hype can carry a stock past its underlying math. I want you to look at the massive spatial gap between reality and the current price. Even when we completely ignore GAAP, accounting and give ARM the absolute best case scenario with the orange non-GAAP target, their fundamental ceiling is mathematically capped at 124. Not only has the current price 209 completely detached from the structural fundamentals, but it has violently broken past the absolute +1 standard deviation ceiling of its 90-day macro statistical momentum band, $186. This is the exact virtual definition of pure momentum hype operating in technical air pocket. The stock has entirely outrun its own massive 41% forward growth estimates. For left side fundamental buyers, there is absolutely zero margin of safety here. You are paying an extreme premium purely for the AI narrative. For right side momentum traders, this chart is flashing a glaring warning. When you break completely above the 90-day statistical band with no fundamental support beneath you, the risk of sharp mean reversion is enormous. Enormous. It is time to ruthlessly tighten your trailing stops. Shifting completely out of traditional software and hardware, we bring in our third new high beta addition, the crypto proxy Coinbase, COIN. This chart provides an incredible lesson on the virtual gap between narrative, momentum, and underlying cash flow fundamentals. The current price is 189. Let's map exactly where this stock is trading relative to its structural gravity. I want you to look at the distinct hour gap on this chart. Even factoring in massive forward growth estimates of up to 50%, Coinbase's absolute macro fundamental ceiling, the red box, is strictly capped at 159. However, look at the purple 90-day macro statistical band. It doesn't even begin until 169. The current price 189 is nested perfectly near its statistical momentum median of 192, hovering completely detached from its fundamental fair value. This is a textbook momentum trade operating in a technical air pocket. For left-side fundamental value buyers, this chart is entirely untrackable. You are paying a massive premium purely for the crypto bull narrative, with zero mathematical margin of safety. However, for right-side momentum traders, this is actually a beautifully controlled setup. The stock is not statistically overextended. It is trading right at its momentum median. You can comfortably manage risk here because you must use that 169 statistical floor as an ironclad stop loss. Because if that momentum breaks, it is a long, hard fall down to true fundamental support. To round out our newly added stocks, we're looking at the massive crowd favorite in the hypergrowth cloud software space, Datadog, DDOG. The market's reaction here has created an absolute structural void. The current price is 210. Let's look at what happens when a software narrative entirely overpowers its mathematical reality. I want everyone to look at the extreme left side of its thermometer. Based strictly on GAAP earnings, Datadog's fundamental ceiling is only $18. Even when we give Wall Street the benefit of the double doubt and map out their adjusted non-GAAP targets, the orange box, that absolute ceiling is still mathematically capped at 103. Now look at the black current price line at 210. Not only it is trading at double its highest possible adjusted fundamental target, but it has violently broken out well above the absolute ceiling of its 90-day macro statistical momentum band, $157. This chart perfectly illustrates a stock operating in a complete technical and fundamental air pocket. The algorithms have dragged its asset into a state of extreme euphoria. For left-side fundamental value bears, there is zero mathematical justification for an entry here. You are paying a massive premium strictly for momentum. For right-side momentum traders, this double breakout is a blinding red flag. When a stock outruns its statistical momentum by over $50 with no fundamental support beneath it, the risk of a brutal algorithmic mean reversion is imminent. Capital preservation is your only priority. Tighten those trailing stops ruthlessly. Moving into our renewed earners, we turn to a high margin anchor of the software space, Intuit, INTU. They just reported their numbers today, and the aftermarket reaction has completely shattered the previous structural gravity of this stock. The current price has gapped shifted down to 330. Let's look at the absolutely massive disconnect Wall Street has just created. I want you to look at the extreme virtual compression on the left side of this chart. Going into earnings, Intuit's 90-day macro statistical minus one standard deviation floor was 372. The aftermarket drop to 330 has violently shattered that momentum floor, dragging the price out of the red macro expected target and landing it directly on the absolute ceiling of its blue deep value floor 330. But the real story is overhead. If you look at Wall Street's adjusted non-GAAP estimates, or the orange box, the fundamental ceiling of this stock stretches all the way to 785. The air gap between the current price and the adjusted fundamental ceiling is nearly $450. This is a massive structural capitulation event. For right-side momentum traders, this chart is completely broken. The short-term algorithmic trend is dead, and you do not step in front of a falling knife. However, for left side fundamental value buyers, this is an incredibly rare opportunity. The market has instantly repriced into it at its absolute worst case historical GAAP multiple. If you believe their software moat and forward growth estimates remain intact, this chart is screaming deep value accumulation, offering one of the largest fundamental runways we have seen in the software sector. We cannot talk about earnings extremes without addressing the undisputed engine of this entire market cycle, NVDA. Like Intuit, they literally just released this fresh data today. The current price is 223. I want you to look incredibly closely at this chart because it maps out a massive conflict between short-term trading algorithms and long-term fundamental math. Look at where the black current price line is resting. It is floating in a literal air gap. On one hand, the stock has violently broken out above the absolute ceiling of its 90-day micro-statistical momentum band, 205. The short-term momentum algorithms are completely exhausted and overextended. However, look to the right. Because Wall Street has priced in a massive 39% forward growth rate, NVIDIA's macro expected target, the red box, doesn't even begin until 235 and stretches all the way up to 362. This is a brilliant chart for understanding timeframe divergence. For right side momentum traders, the math is screaming caution. You are statistical overbought and primed for an algorithmic mean reversion back down toward that 205 level. You must tighten your trading stops immediately. But for left side fundamental accumulators, the narrative is completely different. The math actually shows that the stock has incredible runway just to catch up to the bottom of its historical fair value multiple. If that momentum mean reversion does happen, it will offer a phenomenal structural entry point before the stock attempts to enter its true fundamental gravity zone. To wrap up our 7 fundamental analysis session, we're looking at our final renewed earner and the ultimate legacy fintech structural washout, PYPL. This chart provides a masterclass in market calculation versus mathematical reality. The current price is 44. Let's look at what happens when the algorithms completely abandon a cash flowing asset. I want you to look at the massive fundamental disconnect on the left side of this thermometer. PayPal's absolute worst case scenario pricing, the blue deep value floor, bottoms out strictly at 53, based on their updated 9% forward growth. However, the current price is sitting at 44. It has completely fallen out of the bottom of its fundamental floor. Meanwhile, it is resting just slightly above its absolute -1 standard deviation momentum washout floor of 42. The market is pricing this stock as if its cash flows are dying. Yet the math clearly shows consistent growth. Mathematically, this is a textbook deep value capitulation trade where you are buying the asset at a deep discount to its worst case valuation. However, please look at the critical warning box on your screen. Before you blindly buy this structural dip, you must understand the quantitative threat of a value trap. The digital payment sector is facing severe margin compression and massive competition from Apple Pay and Stripe. If PayPal cannot maintain its structural growth, these historical multiples will break down permanently. For accumulation, this requires a strict, defined margin of safety and the acceptance that a cheap stock can always get cheaper if the underlying business model is actively eroding. That wraps up our massive 7 fundamental analysis for this week. Today, we saw exactly why structural context is everything. We mapped out incredible fundamental safety nets in Intuit and NVDA. Massive algorithmic warning lights across ARM Holdings and Datadog, and the constant battle between deep value and value traps in PayPal. The numbers tell the story. Your job is to listen to the math and position your risk accordingly. If you want to replicate these models and build your own valuation thermometers, head over to section 1.7 of the Quant Lab. Thank you all for joining me, and I will see you in the next section.